Measuring national output and national income. In this lecture, we will see how the total output of a nation or an economy is measured. Simply, we want to answer the question how millions of different types of goods and services produced by firms and companies operating in a country like Egypt is measured. Here, several aspects of measuring a country's total output is covered. First, we describe what is meant by gross domestic product, or for short GDP, and we differentiate between GDP and GNP, or gross national product. Second, we explain the two different methods for calculating GDP. Third, we discuss the difference between real GDP and nominal GDP. Finally, we discuss the limitations on the concept of GDP. We begin with giving a definition of what GDP is, which can be defined as the total market value of all final goods and services produced within a given period, say a year, by factors of production located within a country. We can see from that definition four describing features of GDP. These features are: 1. GDP is a monetary measure of output. Second, GDP is a measure of final output. Third, GDP is a measure of current output. And finally, GDP is a measure of domestic output. What are final goods and services? These are goods and services produced for final use. What are intermediate goods? These are goods that are produced by one firm for use in further processing or for resale by another firm. What is value added? This is the difference between the value of goods as they leave a stage of production and the cost of the goods as they enter that stage. In measuring or calculating GDP, we can sum up the value added at each stage of production, or we can take the value of final sales. We do not use the value of total sales in an economy to measure how much output has been produced. The following table shows an example of how to calculate the value added in the production of a gallon of gasoline. The numbers that follow are hypothetical numbers. The table shows 3 columns. The first column shows the stage of production for gasoline. The second column shows the value of sales. The third column shows the value added at each stage. So for example, in the first stage, oil drilling, the value of sales is 3 pounds per gallon, and the value added is also 3 pounds for a gallon. In the second stage, refining, the value of sales in this stage is 3 pounds and 30 pence, and the value added is 30 pence. Exclusion of used goods and paper transactions. GDP is concerned only with new or current production. Old output is not counted in current GDP because it was already counted when it was produced. GDP does not count transactions in which money or goods change hands, but in which no new goods and services are produced. That GDP is the value of output produced by factors of production located within a country. However, gross national product, or GNP, is the total market value of all final goods and services produced within a given period by factors of production owned by a country's citizens, regardless of where the output is produced. Generally, there are 2 main methods that can be used to calculate or measure the value of GDP for a country. The first method or approach is known as the expenditure approach. This is a method of computing GDP that measures the total amount spent on all final goods and services during a given period. The second method or approach is known as the income approach. This is a method of computing GDP that measures the income in the form of wages, rents, interest, and profits, which received by all factors of production in producing final goods and services or the final output of the country. Consider first the expenditure approach. There are 4 main categories of expenditure. First, personal consumption expenditures, denoted as C. These refers to household spending on consumer goods. Second, gross private domestic investment, denoted as I. This is a spending by firms and households on new capital, that is, plant, equipment, inventory, and new residential structures. Third, government consumption and gross investment, denoted as G. Finally, we have net exports, denoted as X minus M. This is net spending by the rest of the world, or exports X minus imports M. The following table shows an example of how to calculate the value of GDP for the U.S. economy using different components of expenditure using the expenditure approach. Now, what is personal consumption expenditures, or C? Personal consumption expenditures are expenditures by consumers on goods and services. These expenditures include spending on durable goods, which are goods that last a relatively long time, such as cars and household appliances. They also include non-durable goods, which are goods that are used up fairly quickly, such as food and clothing. In addition, there is spending on services. These are things we buy that do not involve the production of physical things, such as legal and medical services and education. The second type of expenditure is gross private domestic investment, or I. Gross private domestic investment, denoted as I, refers to total investment in capital, that is, the purchase of new housing, plants, equipment, and inventory by the private or non-government sector. Gross private domestic investment includes two types of investment. The first is non-residential investment, which is expenditures by firms for machines, tools, plants, and so on. The second type is residential investment, which refers to expenditures by households and firms on new houses and apartment buildings. In addition to the two previous types of investment, gross private domestic investment includes change in business inventories. Change in business inventories refers to the amount by which firms' inventories change during a period. Inventories are the goods that firms produce now but intend to sell later. So generally, GDP would include final sales plus the change in business inventory. Depreciation. Depreciation is the amount by which an asset's value falls in a given period. Gross investment. Gross investment is the total value of all newly produced capital goods, including things like plant, equipment, housing, and inventory, produced in a given period. Net investment. Net investment refers to gross investment minus depreciation. Capital at the end of the period equal capital at the beginning of the period plus net investment. Government consumption and gross investment, or G. These are expenditures by federal, state, and local governments for final goods and services. Net exports, or X minus M. This is the difference between exports, sales to foreigners of Egypt-produced goods and services, and imports, Egypt's purchases of goods and services from abroad. The figure or the value of the difference can be positive or negative. Second, the income approach. National income can be defined as the total income earned by the factors of production owned by a country's citizens. To measure or calculate GDP using the income approach, we have to add up the following. Number one, compensation of employees. This is another name for wages, which includes wages, salaries, and various supplements, employer contributions to social insurance and pension funds, for example, paid to households by firms and by the government. Second, proprietor's income. This is income of unincorporated businesses. Third, rental income or rent. This is the income received by property owners in the form of rent. Fourth, corporate profits, which refers to the income of corporations. Fifth, net interest, which refers to the interest paid by businesses. Sixth, indirect taxes minus subsidies, or taxes such as sales taxes, customs duties, and license fees, less subsidies that the government pays for which it receives no goods or services in return. Sometimes we may need to add net business transfer payments, which refer to net transfer payments by businesses to others, and also may add surplus of government enterprises or income of government enterprises. The following table shows an example of measuring or calculated U.S. national income in 2014 using the income approach. Net National Product, or NNP. This is literally or exactly what we mean by national income, and it refers to gross national product minus depreciation, a nation's total product minus what is required to maintain the value of its capital stock. Personal income. This is the total income of households. The following table shows how to calculate GDP, GNP, NNP, and national income in 2014 for the U.S. Here, several aspects of measuring a country's total output is covered. First, we describe what is meant by gross domestic product, or for short GDP, and we differentiate between GDP and GNP, or gross national product. Second, we explain the two different methods for calculating GDP. Third, the following table shows calculating national income, personal income, and disposable personal income and personal saving in 2014 for the US. Nominal GDP. This is gross domestic product measured in current dollars or market prices. Current dollars or market prices is the current prices that we pay for goods and services. The following table shows the way we use to calculate or measure GDP for a country which produces three goods: